post-Fed sell-off with Ben Emmons of FedWatch Advisors. Ben, great to have you with us. I quickly read through your note. You're quick on the draw in terms of getting this note out. But bottom line, you think yields are headed higher. Full retracement to 475. How high do you see it going in this environment?
Okay, since this came out, there's been, a little bit more digestion of what the Fed was talking about, and I have my own theory as well. For what it's worth, I am a investment advisor, or IAR, to be more accurate. And I've been watching the markets for decades. I have a degree in finance. What I think, so there was some stickiness in their own language of what was happening when it came to inflation. What they're really concerned about what's going to happen with the new administration coming in, right? There's a lot of pro-inflation policies that are coming in at the same time as pro-growth, which is also pro-inflation. But I think they're a little bit worried, right? They're a little bit worried. And something else that might be occurring is, and I don't think this is it, but it could be, is that they might be somewhat worried if the economy tanks for whatever reason. You need some dry powder stored away. And what I mean by that is they would probably have to lower rates to get the economy going again, right? So I'm not quite sure if they are worried if they got inflationary data. I don't think that's what happened when you read the Beige Book notes.
This new environment now.
Yeah, Mel, as Powell said, right, we're kind of shifted environment. He admitted that himself. And, it was interesting to see that forecast come out, because by showing a high inflation forecast and showing, particularly in the back end, the members of the FOMC seeing upside surprise to the inflation outlook, I think.
My man must have just gotten his plantation shutters because he wanted that as a backdrop.
That's what triggered the sell-off today in the market, particularly rates, and that spilled over into the broader market. And yes, you're breaking 4.5 here, as we talked previously. So 475 is the high of this year. So that's an easy retracement. But to an earlier show from April, I believe, it's 5.3, right? It means that's really the upside there. And if I calculated that Taylor rule really quickly on the forecast from the Fed today, that's actually what the Fed funds rate should be today, 5.3. We're about 80 basis points easier. So there's a lot of opportunity here for you.
So if you are new to this channel, and you're going to learn a lot of vocabulary words, right? So there's the Fed funds rate, which is the overnight lending between banks, and then there's the discount rate. The discount rate is what they just announced that day of this piece. The discount rate is controlled by the Federal Reserve, right? They don't control. They have influence, but they don't control the Fed funds rate, right? Just a quick little thing, which is kind of, I looked at this. So the Fed can influence the Treasury and vice versa. What's interesting is that, let's take a look. So right here, right when, I think it was on the 18th. So right here is when they did that quarter basis point drop, right? And mortgage rates still went up, right? Now mortgage rates are tied to the 10-year, but it's very interesting to see them drop their rates and this disconnect that's going on here, right? I really don't know what's driving that. But it has to do with definitely has something to do with the bond market, right? And it's going to be very interesting to see if this disconnect continues or they fall in line, right?
Yields to go higher, I think, given the Fed's change in tone and change in reaction function today.
So how do you piece that environment for equities together for next year if we are to say that rates could glide higher to above, just above 5% or so, but we are also looking for, the conditions for a stronger dollar, maybe slower earnings growth? I mean, how do you sort of put it together in terms of what the environment is for equities?
I don't think it will necessarily be a deteriorating environment because, strong dollar, better.
So I don't think they're going to go up. But at the same time, I looked at, so there's this, let's see if I can find it really quick. Watch this. Let's see if I can CME prediction. CME prediction today. Here we go. Okay, so this is very interesting. So at the time of this piece, I think it was on the 18th, right? It's January 1st, Happy New Year's. This was at 92. This number keeps on going down. What this means is the likelihood of an ease that the Fed will do is it keeps on decreasing. So it could not, but it is just very interesting that this number keeps on dropping, right? And I think a lot of it is tied to, again, a lot of it is tied to the bond market and what you're seeing through treasuries throughout the world and what's going on. But that's very interesting that this number keeps on decreasing.
Growth, high yields, that still talks about that very, very good economy, as Paul said. And I don't think under that condition, the equities would actually sell off majorly. I think we have to just sort of digest ourselves to an environment where the Fed may not just simply be easing any longer. So that's, I think, today's indigestion. But for the outlook, that I don't think changes anything other than if you're getting inflation really coming back meaningfully. So the Fed wants to get ahead of that inflation by being more focused on inflation in their forecast. So I think it's a good backdrop. I think to Courtney's point, the deregulation is a key element next year, including to the tax cuts, that will continue to drive the sentiment. We just have to get used to a Fed that's going to be likely on hold and show a little bit more like force on inflation. I think that's the only thing that could hold equities back.
Ben and Karen, thanks for being on. Yesterday, there's a big piece, Tiger T. Rowe Price of 5 or 6% even 10-year. And one of the things they cited was foreign governments not participating as much. Do you see that happening and adding further pressure to the 10-year?
It's possible, Karen, because that is a good point by T. Rowe. We talk oftentimes like the Fed doesn't have the U.S. doesn't have a deficit problem, has actually a debt maturity problem. And in other words, we're just financing too much with T-bills. We got to move that out the curve. That's still not really priced in. I think that's what keeps maybe these foreigners away a bit from the auctions as T. Rowe analyzes, because if that's the case and we're moving higher with yields, we got to see those high yields first before the foreigners come back. So I would agree with them. I'm not sure if 6% will be the end destination. It's more like above 5%, but that's reflective of an economy, I think, that emerged next year stronger towards more 5% growth. So that's good for equities, but yeah, bond yields should be higher.